So what is this smart money concept or SMC that you keep hearing about? Think of it as a way to read the market's secret language. It's a trading methodology built on a simple, powerful idea. The big players like banks, hedge funds, and financial institutions leave footprints in the market. They move massive amounts of money, and their actions create the major price swings we see on our charts. As retail traders, we are like small fish swimming in an ocean dominated by these giant whales. Instead of trying to fight the current they create, SMC teaches us how to swim alongside them, benefiting from the waves they make. It's about trading with the institutions, not against them. The real value of SMC lies in moving beyond basic support and resistance or lagging indicators that often get you into trades late. Have you ever entered a trade that looked perfect, only to see the price reverse and hit your stop loss before rocketing in your original direction? That's often the work of institutional manipulation designed to grab liquidity. SMC helps you understand this game. It gives you a framework for identifying where these big players are likely to buy or sell, allowing you to anticipate moves with greater precision. It's a shift in perspective from being a reactive trader to a proactive one who understands the underlying mechanics of the market. Why should this matter to you, the individual trader? Because it levels the playing field. The market isn't random, it's a carefully orchestrated environment where those with the most capital have a significant advantage. By learning SMC, you are essentially learning their playbook. You begin to see the setups that are designed to trap retail traders, and instead use them as your entry signals. This approach provides a clear logic for every trade. You're not just clicking buy because a line crossed another. You're buying because you've identified a zone where institutions are likely to defend their positions, giving you a high probability setup with a defined risk. Ultimately, mastering SMC is about gaining clarity and confidence in your trading decisions. It strips away the noise and focuses on the pure essence of price action, supply and demand. It answers the critical questions: why is the price moving? Who is moving it? And where is it likely to go next? By aligning your trades with the intentions of smart money, you are not just following a strategy, you are understanding the very structure of the market. This knowledge is what separates consistently profitable traders from those who perpetually struggle. It's a robust skill that can serve you for your entire trading career, regardless of the market you trade. Before we dive deep into advanced SMC tactics, we must go back to basics. The entire concept is built on a timeless foundation: Dow Theory. Charles Dow over a century ago gave us the simplest and most effective way to define a trend. This isn't some complex formula, it's pure common sense based on observing price peaks and troughs. An uptrend is simply a series of higher highs and higher lows. Imagine climbing a staircase. Each step up is a higher high, and each flat platform you rest on is a higher low. As long as the price continues to make new highs and the pullbacks don't violate the previous low, the uptrend remains intact and strong. On the flip side, a downtrend is defined by a series of lower lows and lower highs. Picture yourself walking down a hill. Each step down creates a new lower low, and every small climb you make to catch your breath is a lower high. The market is selling off, and buyers are not strong enough to push the price above the previous peak. As long as this pattern of lower lows and lower highs continues, the path of least resistance is to the downside. Recognizing this simple structure is the first and most critical skill in any trader's toolkit. It's the market's way of telling you which direction the big money is flowing. This concept of market structure is the backbone of SMC because it tells us who is in control. During an uptrend, buyers, demand, are overwhelming sellers, supply. The institutions are accumulating positions, pushing the price higher. During a downtrend, sellers, supply, are in command, and institutions are distributing their positions or shorting the market. By mapping out these highs and lows on your chart, you are creating a roadmap. You can visually see the story of the battle between buyers and sellers, and more importantly, identify who is winning at any given moment. This is not just theory, it is the practical reality of price movement. So your first job as an SMC trader is to become an expert at identifying these patterns. Pull up any chart, on any time frame, and start marking the highs and lows. Is the price making higher highs and higher lows? You are in an uptrend. Is it making lower lows and lower highs? You are in a downtrend. If the price is moving sideways, creating neither, you are in a range or consolidation phase. This simple exercise alone will improve your trading immensely, because it forces you to align with the market's dominant force. You stop guessing and start seeing the structure for what it is, a clear signal from the market. Now that we understand basic market structure, let's learn how to read its signals in real time. This is where two key events come into play, the break of structure and the change of character. A break of structure is a signal of trend continuation. In a strong uptrend, the price makes a higher high, pulls back to a higher low, and then continues its upward journey by breaking above the previous higher high. That moment when it breaks the prior peak is the break of structure. It's the market screaming, the bulls are still in charge, we are going higher. This confirms the trend is healthy and strong, telling you to keep looking for buying opportunities. Conversely, in a downtrend, a break of structure occurs when the price breaks below the previous lower low. After making a lower high, the price continues its descent and creates a new low. This break confirms that sellers are still in full control, and the downward momentum is likely to persist. Each break of structure is a validation of the current trend. As an SMC trader, you use these breaks to confirm your bias. If you are bullish, you want to see consistent breaks of structure to the upside. If you see them falter, it's a warning sign. These breaks are not just lines on a chart. They represent a victory for one side, buyers or sellers. But what happens when a trend is about to end? This is where the change of character comes in. A change of character is the first sign that a trend might be reversing. It's a potential turning point. In an uptrend defined by higher highs and higher lows, a change of character occurs when the price fails to make a new higher high, and instead breaks below the most recent significant higher low. This action violates the core rule of an uptrend. It's the market whispering, hey, something has changed. The buyers might be losing steam. This doesn't guarantee a reversal, but it's a powerful warning to stop looking for buys and start watching for potential sells. For a downtrend, a change of character happens when the price breaks above the most recent significant lower high. This signals that sellers are losing control, and buyers are starting to step in with force. For example, if a stock is trading at $50, drops to 45, rallies to 48, and then drops to 42, the downtrend is intact. But if it then rallies and breaks above the 48 lower high, that is your change of character. It's the first clue that the downtrend is over. Recognizing a change of character is crucial because it allows you to get in early on a new trend, giving you a fantastic risk-to-reward ratio. It's the signal that tells you to switch your bias from selling to buying, or vice versa. Standard candlesticks are great, but they can be noisy. A single red candle in a strong uptrend can cause panic, and a green candle in a downtrend can give false hope. This is where Heiken Ashi candles come to the rescue. Heiken Ashi means average bar in Japanese, and that's exactly what they do. They smooth out the price action by using a formula that incorporates data from the previous candle. The result is a chart that looks much cleaner and makes trends incredibly easy to identify and follow. Instead of a choppy mix of red and green candles, you'll see long, uninterrupted strings of one color during a strong trend. The beauty of Heiken Ashi is its simplicity. In a strong uptrend, you will see a series of long-bodied green or bullish candles with little to no lower wicks. This visual cue is powerful. It tells you that buying pressure is relentless and you should stay in the trade or look for entries. When the trend starts to weaken, the candle bodies will get smaller and lower wicks will begin to appear. This signals indecision or a potential pullback. You don't need to be a charting wizard to see this. The message is crystal clear right on your screen, helping you avoid exiting a good trade too early due to normal price fluctuations. In a downtrend, the opposite is true. You'll see a series of red or bearish candles with long bodies and no upper wicks. This indicates strong, sustained selling pressure. As long as you see these solid red candles, the trend is your friend, and you should be looking for selling opportunities. When the downtrend begins to lose momentum, the red candles will become smaller, and upper wicks will start to emerge. A switch in color from red to green, especially a green candle with no lower wick, can be an early sign that the trend is reversing. Heiken Ashi filters out the noise, allowing you to focus on the true underlying trend. For SMC traders, Heiken Ashi candles are a fantastic confirmation tool. After you've identified your market structure with break of structure and change of character, you can switch to a Heiken Ashi chart to confirm the strength of the move. For example, after a bullish change of character, you want to see the emergence of strong green Heiken Ashi candles to confirm that buyers have truly taken control. This simple visual aid helps you stay patient and ride your winners longer, preventing you from getting shaken out by the minor corrections that are a normal part of any trend. It's about making your trading life easier and more objective. Now we get to one of the core components of SMC, the fair value gap, or FVG. This might sound complicated, but honestly the concept is very simple. An FVG is just a 3-candle pattern that signals a strong, aggressive move, usually by institutional players. It basically represents an inefficiency or, an imbalance in the market. Imagine the price moving so fast in one direction that it doesn't really give the other side a chance to participate fully. This creates what we call a gap in value. To find a bullish FVG, you'll want to look for a sequence of 3 bullish candles. The gap is the space between the high of the first candle and the low of the third candle. That middle candle is where the explosive move actually happened. These gaps are important because, the market just loves efficiency. It has a natural tendency to revisit these inefficiently priced areas to fill the gap. Think of it kind of like a magnet. So, when you spot an FVG, you're identifying a zone that price is likely to be drawn back to in the future. For SMC traders, these FVG zones are high probability areas for trade entries. If the overall trend is up and the price pulls back into a bullish FVG, it represents a prime opportunity to enter a buy trade. You are essentially getting in at a discount, right where institutions might be looking to add to their positions before the next leg up. A bearish FVG is the exact opposite. It's formed by 3 bearish candles, and the gap is the space between the low of the first candle and the high of the third. This indicates an aggressive sell-off, leaving an imbalance that the market will likely want to correct later. In a downtrend, if the price rallies back up into a bearish FVG, it presents an excellent opportunity to enter a short trade. You're selling at a premium price just before the trend is expected to resume its downward path. FVGs give you precise zones to watch, really taking the guesswork out of finding entry points. The key takeaway here is that FVGs are institutional footprints. Such rapid, one-sided price moves are not typically caused by retail traders. They're the result of large orders flooding the market. By identifying these zones, you're pinpointing areas of significant interest for smart money. When price returns to an FVG, you're not just trading a random level. You're trading from a zone where a significant supply and demand imbalance was previously created. This adds a powerful layer of confluence to your trading setups, increasing the probability of a successful trade. Let's put everything together into a practical, step-by-step trading plan. This is where theory becomes action. First, you must identify the overall market trend. Start on a higher time frame like the 4-hour or daily chart. Is the market making higher highs and higher lows, which signals an uptrend, or lower lows and lower highs, which signals a downtrend? Use your knowledge of break of structure, or BOS, to confirm the trend is continuing. For example, in an uptrend, look for a clear break of structure to the upside. This really establishes your directional bias. If the trend is up, you will only look for buy setups. If it's down, you only look for sells. This single rule will keep you on the right side of the market. Second, mark your zones of interest. Once the price has made a new high in an uptrend and starts to pull back, your job is to identify potential demand zones where it might reverse. This is where you look for a fair value gap, or FVG, that was created during the last impulsive move up. You can also use Heiken Ashi candles to help. The origin of those strong, long-bodied green Heiken Ashi candles that led to the BOS is often a powerful demand zone. Mark this area on your chart. This is your hot zone, the area where you will be patiently waiting for the price to return. You are not chasing the price, you are letting it come to you. Third, define your entry, stop loss, and take profit. When the price pulls back into your marked demand zone, the FVG, you can look for an entry. Some traders prefer a touch and go approach, entering as soon as the price touches the zone. A more conservative approach is to wait for confirmation, such as the formation of a bullish Heiken Ashi candle within the zone. Place your stop loss just below the low of the demand zone. This gives your trade room to breathe but protects you if the zone fails. Your primary target should be the previous high that was broken, the BOS point, offering a solid risk-to-reward ratio, often 1-to-2 or better. Finally, exercise patience. This is perhaps the most crucial step. Once you've done your analysis and set your trade, you must let the market do its work. The setup might take hours or even days to play out. Don't stare at the chart every minute. This leads to emotional decisions. Trust your analysis. If the price hits your stop loss, the setup was invalid. Accept the small loss and move on. If it moves towards your target, manage the trade according to your plan. SMC trading is not about being right all the time. It's about having a logical plan with a positive risk-to-reward ratio and executing it with discipline and patience. Once you've mastered the basics of SMC, you can add more advanced concepts to refine your entries and improve your understanding of market manipulation. One of the most important is the concept of a liquidity grab or stop hunt. Institutions know where retail traders place their stop-loss orders, typically just above recent highs or just below recent lows. They will often engineer a sharp price move to trigger these stops, creating a rush of orders or liquidity that they can use to fill their own large positions at a better price. You see this as a long wick on a candle that quickly reverses. Recognizing this pattern is key. An order block is another powerful SMC concept. An order block is typically the last opposing candle before a strong, impulsive move that breaks structure. For example, in an uptrend, a bullish order block is the last bearish candle before a powerful upward move that results in a BOS. This candle represents a point where institutions absorbed all selling pressure and initiated their large buy orders. These zones act like supercharged demand areas. When the price returns to a bullish order block, it often finds strong support, as institutions may be defending their initial entry points. Combining an order block with an FVG creates an extremely high probability setup. So, how do you incorporate these into your trading? When you see a liquidity grab, for instance, the price dips just below a clear low and then rapidly reverses, creating a change of character or shock. It's a powerful signal that institutions have just loaded up on buy orders. This is an A+ entry signal. Instead of getting stopped out with the rest of the retail crowd, you are entering the trade right alongside the smart money. You can place your entry after the reversal is confirmed, with a tight stop loss just below the low of the wick, often resulting in an exceptional risk-to-reward ratio. You are essentially profiting from the manufactured trap. To use order blocks, you refine your zones. Instead of just marking a general FVG, you can look for an order block within or near that FVG. This narrows down your entry zone to a much more precise level. For example, if a stock rallies from $100 to $110, breaking a previous high, and the last down candle before the move was at $101, that 101 level is your bullish order block. When the price pulls back, you can watch for a reaction at this specific level. This precision allows for tighter stop losses and a better understanding of why a particular zone should hold. It's about adding layers of confluence to build an undeniable trading case. No trading strategy, not even SMC, is a magic bullet that guarantees profits on every single trade. The market is a dynamic and unpredictable environment, and losses are an unavoidable part of the business. Anyone who tells you otherwise is selling you a fantasy. The goal of a professional trader is not to avoid losses, but to manage them effectively. This is why risk management is the most important skill you will ever learn. Before entering any trade, you must know exactly how much you are willing to lose if you are wrong. A standard professional rule is to risk no more than 1 to 2% of your trading capital on any single trade. This means if you have a $10,000 account, a 1% risk is $100. Your stop-loss placement and position size should be calculated so that a losing trade costs you $100, no more. This protects your capital and ensures that a string of losses won't wipe out your account. It also takes the emotion out of trading. When you know your maximum loss is a small, manageable amount, you can execute your plan with a clear head. Without proper risk management, even the best strategy in the world will eventually lead to ruin. It is the foundation upon which a sustainable trading career is built. Before you even think about trading SMC with real money, you must practice in a demo account. A demo account allows you to trade with virtual money in a real-time market environment. This is your training ground, your flight simulator. Use this time to get comfortable with identifying market structure, marking BOS and shock, spotting FVGs, and using Heiken Ashi candles. Execute dozens, if not hundreds, of trades based on your SMC plan. Track your results in a journal. What works, what doesn't. This practice builds the screen time and confidence needed to execute flawlessly when real money is on the line. Do not skip this step. Finally, always remember that you are trading probabilities, not certainties. The goal of SMC is to put the odds in your favor, but there will be times when a perfect-looking setup fails. That is okay. Do not get discouraged. The key is to have a positive risk-to-reward ratio on your trades. If you risk $100 to make $200 or $300, you only need to be right 40 or 50% of the time to be profitable. Stick to your plan, manage your risk religiously, and trust the process. Success in trading is a marathon, not a sprint. And it is won through discipline and consistency, not by finding a non-existent holy grail. As we conclude this guide, I want to leave you with 3 final words of advice that are more important than any single pattern or indicator: patience, simplicity, and adaptability. First, patience is a trader's greatest virtue. The market does not provide high-probability SMC setups every single day. There will be times when you must sit on your hands for hours or even days, waiting for the price to come to your predefined zone. This is the work of a professional. Amateurs chase the market and jump into low-quality trades out of boredom. Professionals wait for the A+ setup. Remember, your job is to be a sniper, not a machine gunner. Second, keep your trading plan simple. It can be tempting to clutter your charts with dozens of indicators and complex rules, hoping to find the perfect system. In reality, this often leads to analysis paralysis and confusion. The beauty of SMC is its focus on pure price action. Your core plan should be straightforward. Identify the trend, mark your zones, FVG or order block. Wait for price to enter the zone and execute with a predefined risk. Everything else is secondary. A simple, robust plan that you can execute consistently is far more powerful than a complex one you can't follow under pressure. Don't overcomplicate what works. Finally, you must remain adaptable. The markets are constantly evolving. A strategy that works perfectly today might need slight adjustments tomorrow. While the core principles of supply and demand are timeless, the market's behavior can change. Pay attention to how the market is reacting to your zones. Are FVGs holding up as well as they used to? Are liquidity grabs becoming more common? A good trader is also a good student of the market, always observing and learning. Be willing to tweak your approach based on current market conditions, but do not abandon your core principles. Adaptability is the key to long-term survival and success. In the end, mastering smart money concepts is a journey, not a destination. It requires study, practice, and above all, discipline. But the reward is a profound understanding of how the market truly works. You will learn to trade with clarity and confidence, aligning yourself with the dominant forces that move prices. So take these concepts, practice them diligently on a demo account, and build a trading plan that you can trust. Focus on the process, manage your risk, and let patience be your guide. Your trading will never be the same again.